All right. Thank you all. It's good to be with you all. Thank you for attending and for being with us all day here. I like to keep the webinar entertaining and sort of upbeat with any kind of questions or commentary. I love the live presentations, but webinars are just as fun, but we like the interaction. So I want to make sure you're awake, make sure the energy's going, and all that. If you talk about our trend day tactics and things that we do, some of the best methods that I use for that. And again, I want to give a shout out to Dean. I did a panel forecast with him just recently this week. Really good time. I love what Dean does and his work, and then Bennett McDowell as well. And Bennett and I share the TradeStation market briefing. I do Tuesday, he does Wednesday, and so good to see my colleagues here and all that. So again, thank you all for having us at Traders Talk Live. Let's jump into the presentation. If you're new to my style of briefing, what I do is I give lots of information and live charts and information as much as we can do for just kind of putting you in the best spot to make money, best probability. Look for trending markets, look for opportunities, for the most part retracements. So I've been doing this. Jump into risk disclosure. I wish it were easy. I wish everything made money, but it doesn't. So legally and just morally and ethically, we have to acknowledge that not everything works in trading. So of course everything involves risk. And so what I like to do is minimize that risk and focus on high probability setups, low risk, low stop, play for larger targets, and play for relatively tight stops. So we'll look at that as we go through the presentation with our trading tactics setup. If you're not familiar with what I do, I've been doing this for 17 years now. Started back in 1998 and 99 as an investor. That became a swing trader once the market stopped going down, and I realized that fundamental analysis isn't the end-all to end-all. The technicals and the charts and the indicators, they've got value, they've got metrics, and they have merit for what we do. And so that's what drove me to the intraday or the swing trading world with charts. And when I went full-time in late 6 into 7, finished grad school, and again with the CMT material. So that's when I started being more intraday. So my focus, I guess, is similar to a lot of people, maybe some of you all, that starts off as an investor, Warren Buffett style material, and kind of jumps down to swing trading. And once you go full-time, you get kind of bored taking a couple of trades for a week. And so that's what got me to the intraday world. And I've been there since 2007, so 10-year anniversary of my intraday and day trading full-time profession. Also with Afraid to Trade. I've been doing that for that long too. Moved to Los Angeles. You might hear my southern accent in there, but I'm in the big city now here in LA and loving it, having a lot of fun. But again, I focus mostly on the intraday tactics and swing ETFs and swing trading larger stocks. So let's jump into it. I'm also the author of the complete trading course there. All right, so if you're not familiar, and if I'm just curious, if you have never heard of what a trend day is, some people love them, and honestly, I make the best in terms of monthly profits. This strategy, this technique is how I get the bulk of my monthly gains as an intraday tactic, intraday account. But sometimes it wasn't always that way, and maybe some of you have been trading for a while or just a little bit here, and a trend day starts to happen. We'll define it. And maybe you fight it, you fade it, you go against it, and what happens is you lose money. So that happens. I consulted with a hedge fund back a few years ago, and they were doing quite well with fade strategies. So they were looking for stocks that had gone too far, or for an intraday basis using different metrics and statistics, and they would fade them. And so what would happen is that worked more than not. Days are not trend days, but ultimately they would lose a lot of their profits that they've made over multiple sessions on a single day. And so that may be some of you, and that was me. I didn't just pop out of the trading world knowing how to trade trend days. You probably didn't either. So everything we do is a learning process. It's based on observation, teaching, mentor, webinars like this, books, all that we get into. It's just people sharing experiences, what works for them and what doesn't. So either we learn it, ultimately with my membership, I love to say this, if you fight or fade a trend day, you can learn that that doesn't work from me, trust it from me, take it from my experience. If you don't trust me, you'll learn it from the market. You don't fight or fade trend days. So our outline for today's session, again, it's good to be here with you. And again, exciting to get the energy level up as we progress. So just simply recognize it, define it. What is it? What metrics go into it? What's going on? Monitor it to go through the session. I'll actually give you in the recording or here at the presentation, or just email me, what's called a time sequence checklist to be part of the presentation for you. And it just goes through and sees what's happening pre-market, what happens on the opening session, gap or no gap, how big's the gap, what happens in the first hour, volume internals and those sort of metrics, and then what happens really around lunchtime, around noon Eastern. So we just go through that, indicated, and we trade it. It's great to think and great to strategize and great to learn, but if you want to make money, you can't be theoretical. You got to put this stuff to work. You got to learn the retracements, learn the stops, learn the targets, and learn how to manage your positions. So don't just have fun, obviously have fun, but put what you learn in all the presentations here and beyond to work. That way you learn really what's working, what your risk tolerance is, and what's best for you, for your personal trading account. Might be thinking of some of these, and you're welcome to type in the chat box whatever questions you may have, but this is what I see with working with clients, working with other traders, and even with colleagues that have great trading systems that tend to be more fade-oriented or reversal-oriented, or what we call mean reverting, mean reversion. If a market goes up, they tend to go short. If it goes long, it goes down, they tend to go long. It's mean reverting fading. It really does work more times than not. But these, what I'm talking about today, are special events. We had a couple of them recently, actually. So they asked the question, why do I lose money when, in hindsight, you go back and look backwards at it, it just seems so easy. Market went up, up, up. And some of the charts that Dean showed on the trading trends, and the other presenters as well showed trends in motion. Great, hindsight, looks great. How did I mess this up? How did I wind up going short or calling a top or calling a bottom or other kinds of reversals? How did I do that? What's going on? And then why do my indicators, if you use Bollinger Bands, for example, see the Bollinger Bands up here, or momentum or Elliott wave, you count out 5 Elliott waves and it goes on to 6 waves, 7 waves, 8, 9, darn it. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, etc. Why does everything that I've learned and had discussed say I should go short or I should go long against it? Why? Why is it happening? And then, of course, just the mental aspect of it. When you see, if I kind of froze this chart for you, if you see this big opening gap and the S&P 500 SPY, that's about 115 points or $1.50 in the SPY or 15 points in the ES futures. That's a lot. Statistically speaking, that's a whole heck of a lot. You don't really see that. And so your natural instinct is to go short or fight it or doubt it or don't believe it can happen. And that's what gets you into trouble, because more times than not, a big trend day that emerges and goes all the rest of the session starts with an upside like this or a downside opening gap that doesn't fill. So it kind of blows through psychological norms, or just what makes us feel comfortable. Is it, my goodness, it's already going up 3%, how much more can it go? It can go 4%, it can go 5%, it can go 6%. So that's just, it's almost a failure of imagination, or just locked into thinking inside the box, or just whatever the case may be. So just think of these questions and more as we go through. And hopefully I'll do a paradigm shift for you. So what's a trend day? What's going on? What's happening? So it's just definition. First tip, first thing we'll talk about, how to define a trend day as it develops and as it progresses. So you'll find out through the presentation that we're looking at early recognition and then confirmation as it goes on. But if you're looking for rules, it needs to typically open at one extreme and close at the other. That's a trend day. Pretty simple. Doesn't give you that much information, but that's what it is. Starts at one extreme, in this case the low, into the other extreme, the high. So it bounces, it's a trading technique, off of your rising moving averages, maybe a rising trend line, maybe if you're more advanced, rising or a Fibonacci level, maybe 38.2, that sort of thing. But it's going to bounce up off of something, and usually it's going to be a moving average. Again, that gap's going to play in there. And if you're looking at stocks, really it's works for anything, but stocks is we'll focus our attention on, you're going to see what's called higher than average relative volume. What's that mean? It means in a general day, general trading session, see the smile? We call it a volume smile. Session starts out pretty big with volume, session ends with high volume, in the middle of the day it goes down and then eventually picks up toward the close. It's called a volume smile. So what you're looking for is not that pattern, it's this pattern. It's when volume, green volume or buy volume, is breaking the norm. It's breaking out of that little arc, little kind of saucer bottom pattern. It's this kind of stuff. So that's what I mean by higher than average relative volume, not just this right here, just how it breaks the smile. And that's a trend day. So kind of a smaller example, this is gold. Not looking at volume, but looking at momentum, but still, definitionally speaking, opens at one extreme, closes near the other, bounces off rising moving averages, that's your trade setups, and begins with a large gap. So that is the definition. If you're taking notes, that's what we're looking for. Gap, unfilled gap, and bouncing off moving averages. You can't really do so much if you close at the extreme, but it's just that by definition. We're going to trade those pullbacks. If you're one of those people like me that needs a little bit more information or needs more confidence to get in positions, to do the trades there, not just taking a random position, but to have substance or have logic behind, then why do these trend days happen? Kind of think about that yourself. Why might that occur? Bulls occur, or bulls want the market to go up. Bears want the market to go down. So what happens? Essentially, one side loses the game, drops the ball, and is pummeled by the other side. So we call these feedback loops. If you're thinking of a feedback loop, it's where higher prices cause higher prices. So forget all these words up here, but just think about it. So price highs bring in new buyers. If the market's breaking out, if Apple's making a new high, that's bullish. We might get on stock twits and tweet about it or talk about it or call our friends or message our friends or whatever, or our colleagues. And so because it's doing something, it causes people to buy, which is fine, we get that. But it also, we don't think about this as much, forces bears to buy. If you've ever been on the wrong side of a breakout move, raise your hand if you have, this is what happens. You place your stop on the outside of a resistance or support level, or at a new high or something like that. You think it's going to go down, reverse, and you get your stop hit. When your short sell or bearish stop, if you're short, is hit, that's actually a buy order. To get out of a short position, you actually have to buy back your shares. And so if that happens in large force, if across the whole country, across the whole world, if people that are short Apple or Netflix or Google or Amazon or the S&P or oil or whatever the case may be, if the market breaks out, they have a choice: lose more money or take what loss you have and get out. And so that's what causes these, we call them feedback loops, but it's essentially, it's good, happy bulls, bad, not bad necessarily, but scared, shaky, nervous, upset, sad short sellers because they're losing money. And the opposite's true. You get really, really happy bears on the way down and really unhappy bulls on the way down. They're taking their stops too. So anyway, that's what the logic is behind these sessions. And I think this is very important to take a moment to realize why this happens, because a lot of times what we get tripped up on in trading is kind of a failure to imagine, or failure to forecast isn't really the right word, but failure to imagine. You can't think it can go any higher. Again, look back to the charts that Dean showed or some of the other presenters, that the market just went up, up, up. Bitcoin, right, there you go, Bitcoin. How, when Bitcoin was $1,500 or $800, whatever, now it's over 4,000? What in the world? And if you couldn't imagine that, and most of us didn't, that's just a failure of imagination. So that's what a trend day on a lower time frame is. This thing, if it starts to move and get motion in one direction, it can keep going, almost like a snowball rolling down the hill. So sadly and perversely, or if you're on the flip side of this process, the people who fight or go against a trend or a trend day are the ones that actually contribute or help it going up. That makes sense? If you're fighting a trend by going short, you actually help it go up. You, not yourself, but collectively, people making the same reasonable decision you are, they typically help it when they exit the market. So here's our checklist. I'm taking notes. This is a big thing to watch as well. We have a bigger example of this in the membership and on the website at afraidtotrade.com as well. But this is, screen cap this or write this out or just email me, and I'll be happy to send the slides or just the slide to you. So we have really a 5-factor list. Forget the bottom here, but discuss the top in terms of the grid. So what you're looking at is when you wake up. I'm in Los Angeles. I wake up about 4 o'clock. That's, icky. In New York, you can wake up at 6. But whenever you wake up, you need to look at what's going on overseas, what's happening in Asia, what's happening in Europe. And so if anything is happening when you wake up, if nothing is happening, probably or might not be a trend day. If something is already occurring overseas before your market opens, probably going to be at least tip the odds toward a trend day. Pre-market, that's an hour before the market opens. For me, that's about 5:30. Market opens 6:30 in Los Angeles or West Coast. It's 5:30. That's 8:30 on the East Coast there. So anything newsworthy, was it a jobs report? Any inflation news? Anything happen? Any government reports, etc. If nothing, probably not going to be a trend day. If so, tip the odds toward the trend day ledger. Now, once you actually get to the open, if there is not a gap, less than 0.5% or smaller, whatever your stock is, or very, very small, probably won't be a trend day. If there's a big gap, probably could be a trend day. And of course, then you have the first hour. That's about 7:30 here, 10:30 there in East Coast. If you're looking at the, kind of put an asterisk down here. When I say nothing unusual, now we can look down. Unusual activity includes, I won't, for the sake of this presentation, not go into it, but market internals. Are market internals spiking, surging, huge new tick high, huge new tick low, huge surge up in breadth, that's the stocks advancing minus those declining. Spikes, anything visually jumping off the chart with respect to market internals? Yes, no. Relative volume, we discussed that. You can chart the last 10 days or just eyeball it. Is today's session abnormal? Is it much, much, much higher volume or pretty much in line? Yes or no, objective. And this is more subjective, but it's volatility, range expansion. And I've been doing things on the blog lately with respect to percentage moves daily, but you can do that too. Just keep it simple or keep it complex. Is today's session, if the average volatility, look at an average true range, whatever you want to look at, if it's 0.5 or whatever, and today's 2, all right, well that's clear volatility expansion. Again, you can just eyeball that. Look at it on your charts. So again, this is going to play into your first hour and then noon, or noon Eastern really, which is just, and here's your kind of time sequence checklist. This goes back to Central Time, but still, overnight session, before the market opens, the open, first hour, the morning session, the lunch period, the 1 o'clock breakout, the afternoon session, and how the market closes. You can sort of tease these out and define them based on your metrics you're looking at there. So another thing to kind of take a look at is this concept. And the membership planning, we do this. We have evening game plans. We have setting up the next trading session. We have all that stuff in the member area for you to kind of look at the plans and see what we're looking at, the key levels, price points, and dominant thesis, alternate thesis. We help you with that and sort of instruct on that. So here's a hint. Trend days, when they occur, typically occur from low volatility conditions. Call them coils or compressions. You might see them as rectangles, maybe see them as triangles. But just as a kind of a general observation, that a lot of trend days will spring or develop from coils or from consolidation or ranges. So a series of range days typically precede a trend day. In other words, if you see 3 or 4 range day sessions or tight compression sessions, it's like a spring loading up volatility. And so you can forecast or think or project the next day has a higher probability of being a trend day than if, let's say, yesterday was a trend day. So that plays into it as well. All right, sweet. So let's make a bunch of money, right? Woo! So yeah, it doesn't work that way, but these are the foundational things to give you, to build on, to work from. And if anything, to stop from losing money by fighting, fading, or going against a trend day in motion. So, we don't make insane amounts of money, but I mean, some people do. It depends on your risk tolerance. If you're very risk-seeking, you can and you will. But if you're more like me, you're more cautious, conservative, protective of your capital, you'll use these as a really good foundation to make profit, and you can do so consistently. So let's see how that works. What indicators do we use? So you can use simple trend lines. Just draw them. We call them flags, bull flag, bear flag, or a retracement. We have all kind of metrics and lessons on that, but it's just general flags. If the market is trending and forms a retracement or a flag, that's a trade. Cool. Trend lines help you with that. I use moving averages. So for my charts, I use 20 and 50 exponential EMAs. I've done this since 2003. That was kind of a stock charts and John Murphy thing that I've kept up all the way through, and it helps me more than really anything. It's a short-term average and an intermediate average. There's nothing special about this. It's just you might find Fibonacci levels, 21, 55, or whatever. It's just the fact that a short-term and intermediate-term average. And again, that defines trend and pullbacks. If you are inclined, you can use Bollinger Bands for targets to play for. The caveat is on a trend day, the market's going to ride the Bollingers. It's going to hit them, keep on going. So it's not necessarily the best option. They work best on range days, but just keep in mind for targets to play for. And volume is necessary. Market internals, if you are trading the ES or the Russell or the NASDAQ, certainly use internals. We have a whole different style of using those. But volume is just as well. So we look at the 20 EMA exponential average, keeping it super simple, as the trigger trend line. This is Apple back a few years. So the market sort of started with a big push down, and here's your really, it sounds weird to say, but your first reaction. So Apple's down about $2 within a couple of hours. You think it can't go lower. That's a V-spike reversal. Maybe it's a support level. Maybe it's whatever the case is. And so then you have a little pullback here. Any touch or near touch or flag retracement is going to be a trigger to get short. That's your trade. Ways to make that complicated if you want to, or just keep it really simple, which I advocate. Your stop will be trailed above the 20 or the 50, as we'll see shortly. So that's basically how you're doing that. As the market does reverse, the next session, next trading day, you get 2 trend days in a row here. You jump up. Oh, it can't go any higher. It's going to peak at 132 and start to go down. No, it gave you 2 additional small. I mean, you can't really miss the beginning with this tactic, but there are other ways to get that. But anyway, you have a pullback to the 20, and that's your point to engage the market. So similar S&P here. So the 50 exponential, your 50, is not necessarily a entry point, but it's a confirming indicator. In other words, if a trend day is in motion, assume that it will keep going, short sell it, or don't get long until the price is above or beneath the 50 exponential, the 5-minute chart. So that's your key thing. And I have a rule for my members, clients, and all that if this is the case, if you short sell, and this when the market's trending way above a rising 50, you've committed an illegal act. The trading police are going to come get you. If not the trading police, the stop-loss police are going to come get you. But that's just a rule you don't violate, because trend days don't happen that often, and they're special occasions. And so when they occur, you'll typically want to engage your normal behavior, but it's not the way the market works. Trend days typically keep going, and it's going to take a lot of people's money away from them if they fail to understand that, which once again, perversely, is what makes the market move. So next, this is perfect. I mean, this is about as good as it gets in terms of a trend day action. It's Apple, and looking at the gap up, and this is just boom. And even the next session, you can see the next day, not necessarily an intraday tactic, but next day was actually up and higher. So even though it still did a trend day up, it kept going higher. So each little pullback, and we'll talk about stops and targets next, but each little pullback is a valid entry. Low risk, high probability entry into a trend day. So anything that goes short up here, it's actually illegal, cost you money. So here's the basics of how to trade these things in a simple sort of metric. We want to be buyers of retracements to a rising average. Trade the bull flags, look at the trend line, etc. But just as simple as that. If it comes close to or touches, we have a rule for that, we want to be buyers. And if you look at the flags from Charles Bukowski or Martin Pring or John Murphy or Edwards and McGee and etc., just anybody that talks about a flag, that's what we want to do as our trading behavior. Buy a flag, buy a pullback. And we can use lots of metrics for that. So if you do not want to buy a retracement, which I think is safer and more secure because your stop is tighter, you actually can buy breakouts. We'll talk about that later. That's actually playing for a pop stops. When a market goes to a new high, it's going to drag the short sellers kicking and screaming against them. They're going to lose money. And so if you buy that spot, you actually, in some cases quite literally, take their money. You've heard trading is a zero-sum game. If people are shorting a high and they take their stops and you're buying the high, their stop losses become your position. So you essentially are profiting from their, not misery, it's not the great word, but profiting from their failure to see what a trend day can do, see the potential of a trend day. We'll put it that way. So how do you exit? Lots of metrics on exit, but the minimum target on a retracement is the prior high. Usually not enough profit in that. So you want to hold as long as possible, capturing as much profit as possible. So exit on a break of a rising trend line or maybe a reversal candle. And so we have a lot of ways to do that. Place and trail your stop. I would argue under the 50 to be safe. Let this thing get that, retrace and hit that and come back off of it. But if you are more conservative, you can trail it, I would argue, in between the 20-50. If you're really conservative, just a little bit beneath the 20. But be sure to get back in a position that's stopped out if the market keeps going up. You do want to be as committed into these positions as possible, for the most part. Not your whole account, obviously. We at Afraid to Trade take a look at different entry metrics. We look at aggressive entries or conservative entries. An aggressive entry just is, you don't need that much information. You trust the system, trust the trend, trust your trading performance, all that, and you just wait for a pullback and you get in. Market touches, we call it the touch rule, touch that 20 exponential, in the market, done. And that's essentially the advantage of that, is it gets you a super, super close stop and the bigger distance toward your target. Why would you not do that? Because the market can go hit this average and bust on through it. So if you're more worried about percentage or getting a high win rate, you might, and new traders especially, might want to look at conservative tactics. That's when the market hits a level, comes up away from it, and does something else. We call it the break rule. Break above the, in this case, a trend line that's drawn. And by the way, this is a daily chart, but it could be a 5-minute, it could be a 1-minute, it could be a 15, it could be a weekly. This logic applies for all retracement trades. So if price breaks, so to some, an aggressive tactic is a touch rule, touch the average, go, and a conservative is a break rule. Touch the average, but don't get long. Let the market break above. That's how we play those. Won't make a judgment, but typically a new trader might look to be more conservative. As you get more experienced, you're going to want to make more money, and you're actually going to care a little bit less about your percentage correct rate. So if you're going to squeeze out more profit, tilt toward more aggressive trades. But realize you will be stopped out more than somebody who is more a conservative trader. A few weeks ago, I love Apple, as you can tell, but Apple had a gap down. Apple jumped about $1. So this is October 10th here. Jumped about $1 on high, very, very high relative volume. Okay, well that's foundation for a trend day. There you go. Do you walk up and get short there? Nope, don't do that. You wait for the pullback. So the pullback does take us to our 20 exponential. It's green. If you don't want to short there, you actually get a pullback or a break under your trend line. Where do you exit? when the market goes trend line, trend line, trend line, trend line, trend line, whoops, right here. So about 157.50 for that little, see it breaks a reversal candle. This reversal candle didn't actually break and go highly above it. This one clearly did. It also broke a trend line. So trend line, reversal candle, exit. If you're aggressive, you can count that as a trade, but didn't. And look at your relative volume. Look at that. That is the smile, but look at the smile. It's busted. You have a lot of volume in the midday. That's abnormal. Doesn't usually happen. That's what we call in Dow theory, or just in general, confirmation. It's good. You want to see markets going down on high volume because that means it's probably going to keep going. And that's what happened. So despite the fact that Apple jumped down $1, over $1, let's see, it fell it fell $3 more by noon and Pacific time. So you've basically had a fall of $4. My goodness, that's a lot. How much more can this thing go? Well, it popped down $2 more. So Apple fell essentially $7-ish in a single trading session. Not end of the world, but still, trend day metrics, if you were fighting it, you were going long. And I get it. I get how logic would say it can't go down beneath 156 or 157. There's a support line, reversal candles, 1, 2, 3, 4, 5, whatever you want to throw at the market there. But ultimately it did. And so that's just the simplicity of a trend day in motion and why we don't want to fight it. And even a lot of indicators, volume itself, reversal candles itself, maybe there was a Fibonacci level, whatever the case may be. It didn't work, kept going. So those who did get long helped the market go down with their stop losses. And anybody who got short at level 2 or trade number 2, pullback, or the breakdown, that just added money to their account. Netflix, same day really, not quite as dramatic, but still a gap down of about $1, $1.50. Same thing, don't just walk up and short it. Wait for your pullback, wait for the break, bear flag in this case, stops between these two levels. If you're super aggressive, stops above your 50. Same thing, lots and lots and lots. In fact, the midday volume, look at this, midday volume for Netflix here was well above the morning session. You don't usually see this. That's something I don't normally see as a trader, when midday volume is higher than opening volume. And if that's the case, that's an extremely important signal. It just means that the volume is high and the selling pressure is being confirmed by the trading activity. And once again, oh, that's a reversal candle. Oh, it's all that kind of stuff. That's true. Nothing's wrong with that whatsoever. But the better play, all you got up here was 1, 2, 3, 4, 5, 6, 7, 8, about 7-ish green bars. If you miss that, you trade's over. But then see how long it took the market to fall, and it got its minimum target, which is a retest of these little candles here. Besides that, it was in the close. So we don't really hold overnight with this particular metric, this strategy. So wasn't a perfect outcome. You had to wait sort of a little bit, but it did get the target. So that's an advantage of using wider stops. But even that, as much as it looked like it was going to reverse, still had a retest of the low. This is kind of one just to show you the purity of it. Gap down, big ES, gap down, pull back here, where's our trades? Oh, there they are. So what I like about this strategy is it doesn't let you have just a one-off. In other words, if you miss the touch of the moving average or miss the trend line break, you're done, bummer, can't get in the trade. That's not the way this strategy works. Each little yellow spot is called a zone. And so you really get a zone to short sell. If the market is going to keep trending, it's going to keep going lower if that's the case. And so when you get short is a little bit less important if you're maybe like me, like to be a perfectionist. With my executions, I got to get there right at the average or right on that break, or otherwise I'm just going to miss it and throw my hands up and be like, oh, darn, next trade. You don't have to do that. You don't have to worry and stress about that. A pullback is a pullback. And there's actually multiple ways to enter. Once again, this is based on trust. Trust about the market structure, trust on what we call the feedback loop, or the power of the trend. And so if you have that foundation psychologically, and have seen this happen many times, you trust that the market probably, although not guaranteed because that's your stops, all these are stops, If it doesn't work, you just get stopped out. If it does, there you go. And there were at least 3 opportunities to trade into this falling market that really fell a lot more than people expected. A recent one, very recent one actually, a few days ago. This is August 22nd. Got a couple of good trades off of this one for us. And once again, you don't just walk up and get long. You don't sort of hold your eyes and get long, because that's chasing the market. Not good trading behavior to chase. It would have worked out, but you don't do that normally. And so anyway, you get a gap up away that's about a 10-point gap, 8 to 10-point gap in the futures. And if you count this 2 bars off, that's about a 15, 20-point gap up. That's a lot. It's a lot of ES points, trust me. But the end of the day, it took us essentially 25 points higher, or almost 30 points higher. So a lot is a relative term. So sort of eliminate that from your vocabulary. The market in a trending environment can go further than people think it can go. And if you're fighting it, you're gonna lose money, no matter what logic or whatever the case is. And trust me, I love technical analysis. I'm all about it. But trend days are a special, outside the norm behavior. So think of them like that. They're not so much breaking the rules, but it bends the normal rules. That you short into an upper Bollinger, or that a divergence means the market's going to go down, or a 5th wave means that you're done, market's going to top, or a reversal candle, or so on and so forth. These are to be treated as unique or special events, which is why when you understand them and trust them, I keep saying trust, but it's just a observation and a strategy metric, you tend to do well, and it's efficient. You don't have to do all that much thinking. In fact, the more you think, sometimes the worse you perform with these things, which is ironic, but it's just, again, supply demand. It is a complete dominance of the buying side of the market over the selling side. So 2 trades up and it closes at the highs. A few days before that, we had a big down day. Not so much a huge gap, again, a 6 to 8 point gap, but did you think the market was going to go from 2465 to 2420? I didn't. Most people didn't. And that's in the next session too, by the way. We added the next day to that too, because I'm just showing you how important this logic and strategy and thinking is with respect to trading tactics. So again, you don't just walk up and short it. You could, but we don't do that. So we looked for more professional pullbacks or risk-managed pullbacks to the 20 on a trend line break, so on and so forth. There's actually multiple entries. Look at this. There's multiple entries on each little subsequent touch. If you're in a position, you don't keep short selling, but if you got short here, your stop is never threatened, so you keep holding short. But if you didn't get short here, you have multiple chances to get into a falling market. One more, a couple more. So here's another one. Not that much different. Gap up, ABC pullback, break above, trend line, touch the average, trend line, touch the average, and this thing went up to the highs. That was what a 40-point move ish in the one session. And you can go to a lower frame, kind of the same little, it's the same chart here, but I'm just showing you how you can jump inside of it for an actual trade. So your stop is beneath your little 20, maybe even less than that at your 2050 moving average. Just kind of keep it simple, tight stop strategy. Your breakout entry, look at this. We use a little stop here because you're entering on a breakout. You could have entered down here on the touch, but either way you do it. So here's a reference. If you're playing for a breakout conservative entry, you got about 8.5 points in the futures. If you went for an aggressive entry, you got about 12. So 4-point-ish difference there. Where do you exit? Trend line break and a 5-minute reversal candle low break. The market kept going, great, but that's just how you would do a metric or a rules-based entry on the touch, on the break, and your stop goes under these little pivots. Where do you exit? Ideally on a reversal candle breakdown or a little hand-drawn breakdown. And not that I don't want to belabor the point, but these are just how these things work. And I think the experience, the more you see them, the more you get conditioned to realizing, hey, this really is different. Let's end with a final tip here. And it's something that one of my colleagues, one of my clients that I was teaching in the mentorship program just brought to my attention, because I did this without thinking about it, but he's like, well, how do you visualize? We just extend. And it was kind of a light bulb moment. And so I wanted to share that with you. Again, we sort of fail or can't see how far these things are going to go because of lack of imagination. So visualization, whatever word you want to use. But so what I recommend you do is, and I use TradeStation, but you just expand the chart. So I do a little thing here and expand it. So if this is what you're seeing in real time, which is what you're seeing in real time, this is a ES futures, gap down, big move down, and a couple of retracements. You're like, oh, and trust me, I'm looking at this without knowing. I'm like, this is a reversal. It's in da-da-da. So I'm going to get long. Ooh. Well, okay, well, let's talk trend logic. If you simply do this, you expand. It's the same chart, right? Just right here, go back, right there. It's the same chart. And all I did was extend the pathway. I pulled my chart time frame a little bit closer. That way I can see the bottom. I can see prices going down. And all you did is, okay, now this picture looks different. Doesn't it look different? Super, super falling moving averages, touching that 20, lower low, lower high, lower low, lower high. And so that helps you, I think, or helps me at least, put on trades that you might not otherwise have taken. Or, goodness forbid, if you wanted to go long, which is perfectly logical. Get that, I understand. It's going down a whole bunch, but the worst thing you can do right here is go long, because this is what happened next. It fell 10 more points. This right here, if you go back to the first one, think along here with me, there we are, can you visualize this going to 20.95? Probably can't, and honestly, I can't either. So what you do is you draw your chart scale. And sure enough, you got a couple more trades. The market did break that 20 if you were short, took your stops, but still it went 10 points lower. So that's kind of a concluding tip for you. A few minutes left. Let's be real with Corey. Yeah, I get it, done it. It's understandable to doubt, or I said trust a lot, how far a swing can go. I get it, totally. They are not common. You're not going to get here and take 10 trend days in a row. You might get 3 to 5 at the most in a month. However, as I've mentioned, a lot of the profits, because of the strategies that I do and things I like to trade and I'm comfortable trading, that's how I get about 60% or more, depends on the month, of my profits is coming from about 3 or 4 sessions. Hard truth, but that's, you got to show up and do it. You can't let it go. You got to be aggressive on these days. Or if you make 18 days of profit, you're doing quite well. You're getting a couple $100, couple $300, $400, $500 here, lose a couple, whatever, and you blow $2,000 in a single session, or whatever your account size is. You might blow $20,000. I've seen one of my clients blow 20 grand in one session doing this, fighting a trend day. That's why I essentially help them as a client. But these things happen. It depends on your account size. So 1 or 2 sessions, if you go the wrong way, can blow out your trading profits for the month. And I'm sure it's blown out a couple of trading accounts, probably more than a couple. So please pay attention to that reality. They really are the most efficient way. You don't need deep level CMT level technical analysis, knowledge, and expertise. You don't need that. You need to understand what a trend is, how the trends work, how the intraday chart's set up, or how the intraday movement sets up, and then just short sell them. Trust yourself, trust the market, go with it. And so simple strategies, big results. Again, 2, 3, 4 times per month. Isn't something you do every single day. I wish it were. And then again, I teach a lot of this. I have more metrics. I'll share with you this. We do the 10 core principles of technical analysis. We have 3 full months of you in terms of what we're looking at for our. Thanks for attending and paying attention and get you more information. If you want to learn more, this is a good chance to do that with this particular methodology and more. This is just one metric that we use. And of course, what would be beneficial is your Trend Traders Perfect Pullback Bundle. And that's at premium.afraidtotrade.com/trend. So premium.afraidtotrade.com/trend. And that's going to be $525, just kidding, $147. That's 3 months. That's $67 a month, but that's going to cut it down. And these things are $145 or $147. This is going to be essentially all folded into one. 10 lessons, additional lessons on the trading, the pullbacks, 3 months of follow along, game planning, education, all that we do, when we do things beyond the intraday. We look at ETFs, we look at gold and oil, we look at commodities in general, we do some swing trade stuff. This is just one thing that we do, and I just wanted to focus on this because it's the biggest thing that I enjoy. I love all of it, but trend days make me like I'm the king of the world, yeah. But maybe that will be the same for you as you learn these strategies. But that's what I'm offering for today, and I'm thankful for you attending. And this is kind of what goes inside of our intraday reports. A lot of stuff to go into. I won't go through it all. But again, we have more information here. premium.afraidtotrade.com/trend. And I'm on Twitter. Again, for the chart, the time sequence checklist, Corey@afraidtotrade.com. Free blog, no pressure. blog.afraidtotrade.com. And more information at our premium. So again, afraidtotrade.com. Thank you so much for allowing me to share my little passion and one of my top trading strategies and ideas with you. Best of fortunes to you all. Hope to see you all soon. Give me questions if you need them. I'll turn back. And again, thanks to Traders Talk Live for all these presentations today.